Welcome back to the second episode in our Smart Money Concept series. Today, I'm going to be going through order blocks and mitigation. If you're on UK crypto Twitter, order blocks, or usually they abbreviate to OBs, are a concept that are thrown around a lot. You've probably seen them around. If you don't know what they are, they can be very confusing to get started with. So, in this video, I'm not going to show you guys how to trade with them. That will probably come in the next video. But today I'm going to introduce them as a concept and how they work and why they happen. So let's get into it. First thing you have to talk about is the market, right? The market is composed of buyers and sellers. This is a very basic concept, right? For someone to buy something, someone has to be selling it. For someone to sell something, someone has to be buying it, right? Very simple. Now, the markets that we are involved in, they're not small, especially these cryptocurrency markets, stocks, forex, whatever you may be in, right? These are very large markets. There's a lot of money flowing through them every single day. So therefore, going into the second point, we have market makers, we have larger entities in the market. The reason there's so much money in these markets is because there's big corporations, there's things called hedge funds, there's the big companies such as Google and Facebook, whatever, they probably have investment branches as well. A lot of people are involved in this market. And then you've got retail. When people refer to retail, it's normal investors. It just means people like you and I who are just putting our own money into the market and trading with it, investing it. Next thing is winning and losing. So of course, like I said, we've got the bigger players and we've got our retail being our smaller players. Usually, with most markets, I don't know the exact figures, but it's something crazy. Around 90% of people lose money when they come in the market, right? But I'm not surprised. When you start understanding why these things happen, it's not very surprising. 90% of people lose money in forex, crypto, whatever. Now, that 10% who are making money are usually these larger market entities. They're like I said before, they're the corporations and hedge funds and so forth, because they're the market makers. They essentially create these markets. And when I say create these markets, this in itself is another concept that I will cover, but I'm not saying they sat there and literally created this market from scratch. But the way these markets move, when they head in certain directions, when certain moves happen, these bigger market makers are usually the people who they're essentially manipulating the price, manipulating these patterns, and lots of other things. I'll go into a bit more detail, but all we need to know for now is that there's bigger market players and they essentially control the market and they make all the money. And for them to be making the money, the majority of retail traders are losing their money. So the first concept is order blocks. I know I said quite a bit there. Just keep it simple. Try not to think too deep into it for now. But yeah, so order blocks. So order blocks, another word, institutional candles. Sometimes people call them institutional candles. They're areas where you can expect price to react bullishly or bearishly. So of course you can only be bullish or bearish in the market, or at least when you react, price isn't just gonna go sideways. I mean, it can, but in this case with order blocks, right? So if we just get straight into it, so right here we've got something called a bullish order block. The bullish order block is this red candle, right? The one where my mouse is hovering right now. What's happened is price has come back to it. So price has gone away first after the order block's been created. It's come back. We've come to this order block. And then look, we've had a very, very bullish reaction. Literally just got 3 green candles back to back, just straight up. And then, we've gone quite far with the price. So that was quite a bullish reaction. So here they can be found on all time frames. Order blocks are the result of price manipulation from larger market participants, like I said before, institutions, wells, hedge funds, so they can get better entries for their own positions before changing market direction. Price returns to these zones usually at the 50% of the order block to mitigate the initial positions of the larger market participants. So let's just ignore this bottom bit for a second, right? So I made a poster on this, and I'm sure the people with no prior knowledge might have struggled to wrap their head around it, right? So over here, I say they create order blocks to get better entries for their own positions. So over here, what's happened is price is coming down, 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 down. And we all know in the market, price can't just head in one direction. So price is ready to make a reversal. His price is ready to turn, right? And what's happened here is an entity, so an institution, a hedge fund, whatever, somebody has come into the market and they've sold. So they've pushed price even lower and then they've bought. So what happens is they started this selling, retail probably jumped in, started selling as well. They've pushed the candle low, bought in at a better price, and then of course it started a bullish reaction. So over here, of course, they bought it, but then other market participants, such as the retail, would have been buying as well, if that makes sense. So they come in, they sell. Now they've sold to here, they start buying. So they're selling and buying at the same time, right? They come over here, push price up, other people jump into this bullish action, they start buying as well, price has been pushed up, right? I hope it's not too complicated. Literally all they're doing is pushing price, then pushing price down, or well, not always down, because they can be pushing it up as well. It works both ways, buy or sell. But they're pushing the price down here for this specific example, then they're buying in, and this is so they can get a better entry for their buyer over here, right? So the next concept I lightly mention here is mitigation. So now it should start to make a little more sense, right? So mitigation means to remove. Order block mitigation takes place as the larger players in the market open a buy and sell position at the same time, then manipulate price to bring one position to break even before pushing price in the favorable direction. It's quite a mouthful there, but essentially, here I'll talk about the example, and it's the same example as the previous screenshot, right? So what's happened here, now this is how you need to view it. This candle, our order block, is where this institution was selling. So this institution sold, then they bought. So now they've got two positions open at the same time. They've got this sell over here and this buy over here. So this buy has gone into profit, but this sell has gone into loss, right? So what they need to do is push the market down, right? They've pushed the market down, and now we have something called mitigation. So why does mitigation happen? Of course, like I said, let's keep it simple. They sold. And now that they've sold, their position is in a loss as price goes up, up, up. From here, they have to push price down so they can come back to this price point around this level and then mitigate the initial entry. So like I said here, in simple terms, mitigate means to remove. So what they're doing here, this sell that they executed for them to have a better buying price now needs to be removed for them to, of course, be in profit, right? So what they're doing here, they've pushed price, then they're pushing price back down quickly, and then now that they're over here around this price point, what they're going to do is get rid of their sell position. So now they've only got a buy position left, right? And they bought in somewhere over here, and now look what happens to price. They buy. So sorry, they don't buy, but once they get rid of their sell position, price is pushing the opposite direction, correct? So here, once their sell position is removed, look what happens. So our mitigation is the sell position being removed. Of course, if it was the other way around, it would be your buy position being removed. But in this example, this sell position is removed, price is pushed up. They initially brought in here, so over here, of course, they would have been in a lot of profit. So on my example, I've got two things marked up, right? So we have price manipulation and we have continuation. So why is this price manipulation? So this price manipulation, what's happening here is we've had a reversal, right? So now a lot of people are thinking price is going to continue to push up, which is correct because it does. But what happens here, the reason I've marked this up as price manipulation is because the market mover, the person who was essentially manipulating all of this, has created this bullish movement to make the retail and other investors think we're going to head up from here. And once the bullish momentum has essentially been caught on, and now a lot of people are buying in, prices then push down, they've quickly mitigated, and after after the mitigation, of course, because people are buying in and they believe, you know, we're about to see something that's going to be bullish, then price continues to be bullish and they're in profit the whole time now. So essentially all they've done is move the market around, convince people that's going a certain way, and they've played it in their favor. This is why I mentioned they push price in the favorable direction. They sell because they always wanted to buy. So this candle is called a sell to buy candle. They sold so they can buy. This sell was purely for this buy. If you're buying, they expect price to go up. This is why they push price up the whole way. The last concept I want to cover, I only discovered this recently. Looking into it does make a lot of sense, and I learned this from someone called Omar. I'm gonna put his Twitter in the description below, so you guys can go onto his Telegram and so forth, and literally get it from the source. And he's a very good teacher. But if we have our mitigation, so now we've spoken about why order blocks happen, not why they happen, sorry, why they're created, and why mitigation happens. So now the thing is, with mitigation, a lot of the times, of course, I'm not giving you guys practical examples, I will in a second, but with mitigation, a lot of the time, what you're going to see is price usually comes to the open of the candle. So this order block, price usually comes to here, or price comes to 0.5. Me personally, I take trades at the 0.5. This is for a higher risk to reward. To me, it makes more sense for the price to come here. I guess it's more of a preference thing. It's a personal thing. Realistically, you could enter at either points and still be in the same trade, but your risk to reward will be a little bit different. So let's get into it, right? So our 0.5 is the halfway of the candle, right? So a candle body shows where the bulk of the orders in a given time frame took place. So what this means, let's look at our order block, right? If our candle body is here, this means most of the orders within this candle, let's imagine this is I don't know, let's say 15-minute candle. Within this 15-minute candle, most of the orders took place within this body. That's why the body is there, right? The 0.5 of the candle is known as the mean threshold. So what does this mean? So in simple terms, mean threshold, in very, very simple terms, means the middle or the average. So what this means is that at this price point, this is the average of all the orders that took place. It has to be, right? Because if your highest is up here and your lowest is up here and the bulk of your orders in here, now in school we all learn how to calculate averages. Essentially, you just add everything together divided by the amount. So like I said, this isn't something that's necessary to know, but if you factor this in with the first two concepts that I just showed you, it should just make a bit more sense. They push price to this specific level. Why does price come here? It's not understanding why price is coming down can, help assist in building your trades and finding higher probability setups, because when there's just candles in front of you and price action, it's just a chart. But if you understand what's happening behind this chart, why these things are happening, it becomes a lot easier to see where you're making money and which movements you're essentially trying to join in with. Because when you use smart money concepts, we're essentially piggybacking off the manipulation from these wells and institutes. We're just following the movements that they're creating and profiting off of that. So yeah, they push price to 0.5 as it's very likely some of their positions were here or at least around here, because this is the average order. So if they're the person making most of the orders in this candle, considering this is a manipulated candle, this candle was created as a sell to buy, as I mentioned before. That whale or institute, they sold off here, then bought in during this candle. So in this candle, they're going to have a lot of orders as they were trying to push price down. So bringing it to the average point makes a lot of sense, because it's very likely that some of the orders sit over here. So now, let's go into the charts. We're going to just jump into a few examples of just identifying order blocks. I'm not really going to get into the trading side of it. I'm going to save that for the next video. I don't want the videos to get too lengthy, so yeah. Okay, so this is the lunar chart, right? So what you see people do a lot of the time is drawing something like this. So this, if you don't know what it is a Fibonacci retracement. I've got another video on this. If you're not sure how to use them, this is how you can use them. So the first thing I quickly want to go through, right? With your Fib retracement, what I see people do is sometimes draw just the body. So they'll go from the top of the candle to the bottom. Some people will do from the open of the candle to the bottom wick. And then another common one that I see is the whole candle. So wick to wick. This is your whole order block, right? So here, this candle, this one here in specific, let's just zoom in a bit more. This red candle, this last red candle before the move up is a sell to buy candle. So in the example that I gave you guys in my presentation, there's something similar. We see a push down of price and then we see a push up. So then what we've had, so how I draw my fibs is from the open, right? And of course you can enter at the open or at the 0.5. Usually I do enter at the open, so this trade I would have caught this. So what I would have looked for, so this is where it gets a bit complicated. I'm not going to go into too much detail, this will be in my next video, but here we had a breaker structure, right here, because this was our previous high. This high was violated, it was broken over here. What happens, so on people's charts you see it's marked up as BOS, which means breaker structure, or MSB, market structure break. So I usually mark up as BOS. We've had the market structure break. So what happens is once you find this market structure break, you can look at your order block and say, okay, this is the order block that caused this market structure break, this breaker structure. So now price should theoretically come back and respect, it should respect this order block over here. So if I was trading this, what I would have done is, let's go in long position. So I would have looked to enter around the open of the candle, not even around, at the open of the candle. And then what you do with your stop loss is set it just below. By the way, this is how I do it. This is the biggest thing I want to say. This is not how I'm telling you to do it. This isn't financial advice. With your strategies and stuff, everybody has different strategies. They do it differently. They trade differently. This is how I've learned and how I do it. And I say it is a pretty common way, but it's always worth doing your research and learning to do it yourself and seeing what works for you best. But yeah, back into it. So essentially I would have entered at the open, and you can see that's almost no drawdown. Of course you have a little bit of drawdown over here, and stop losses here is quite a safe one. And with your take profit, of course, I've just drawn this in for hindsight's sake. I'm not saying this is where I would have put my take profit right at the peak, but with my take profit, I do play around with it. There's different reasons. There's a support here. No, sorry, there's a resistance here, so you can play it at the resistance. You can play it at an imbalance. So after this move down, if we could go, so this is, I mentioned this in my last video about imbalances, right? I talked about blending concepts together. This is another thing that the person who taught me about mean threshold touches on quite a bit, about blending everything together, right? So if we come over here, right, this was a fair value gap. In my last video, I speak about FVGs, imbalances. So what you could have done is enter your trade here. You've got your stop loss here because you want it just below the previous low. And then what you do is target 50% of the fair value gap. So I would have had my take profit around here. So that's almost a 1-to-3 ratio trade. It would have been quite an easy one, no drawdown, and it went to the take profit relatively fast. So yeah, that's essentially me just building a trade around this order block, right? So now let's try and find some other order blocks. So that was just a quick snippet, I guess, a look into how order blocks are created, or not how they create, but how they're used rather. Over here you got another order block. So I mark my order blocks up with fibs. What you might see on other people's screens is something such as this. This is how they mark up the order blocks. Usually not in a red box. It will be different colors and whatnot, down to preference. but they'll mark up order blocks like this. And once you know order block is there, of course you don't have to if you can remember, but I like to mark them up as something like this: 15-minute OB, meaning 50-minute order block. Just leave it on my chart. If I'm trading the 15-minute, I'll just leave it like this. But the thing with order blocks, and I mentioned this before, this is what I like. You can find order blocks in all time frames. So over here, I've got one marked up. So let's draw fibs on. Doing body to body there. And now, same thing here with a trade. What I would have done is trade the open of this order block. Unfortunately, if I'm trading the open of the order block, assuming that I would have tried to get in around here, like I said before, we spoke about breaker structure and so forth. I would have been trying to get into the position around here, right? And I'll go into more detail about this in my next video, but this is the last up candle before the move down, right? This is why it's our order block. There's other order blocks as well, so it doesn't always have to be the last candle at the peak. For example, let's imagine now here you've got an order block, right? This candle, correct? Because it's your last down candle before you move up. But at the same time, you could also consider this candle as an order block, because that's another down candle before you move up. So essentially, what I've seen and learned, and somebody can correct me if I'm wrong, I believe the last candle, essentially the low, the peak on either side is usually considered an institutional candle. And when you can find order blocks in between the movement, you can call them order blocks, but usually it's just best to refer to it as an order block, because that's what I've seen a lot of people refer to it as. If you include that in your TA and you're mentioning it to other people, it'd just be easier for everyone to understand, right? Okay, so some final key points to touch on before I wrap it up. Mitigation can occur at different levels. So in the video, I spoke about mitigation at the open of the order block, mitigation at the 0.5 of the order block. It doesn't have to be those specific. Sometimes there's no specific level, price is just pushed down and then resumes going up or down, whatever, from, essentially a random price point. Of course, it's not random because that's where somebody started buying, but what I'm saying is it's hard to pinpoint every single time where it's happening. So it is, I wouldn't say best, but it would be good to go with the open of your order block, because that's where you're likely to catch most of your trades. Even if it goes to 0.5, you have a bit of drawdown, at least you're still in the trade. If you only aim for the 0.5, as I showed in the example on TradingView, then it might miss your entry. It's not going to get in if you're not getting in at the open. So mitigation can happen at different levels, so you just have to keep that in mind when you're building your trades. Equal highs and lows. I'm going to make a video on this. This is a very necessary video on liquidity and how liquidity in the market works, right? But in very simple very simple terms, you can have something called equal highs and lows. It's simple. When you have 2 wicks which are relatively the same, or either above price or below price, what you can usually expect price to do is take them out. When price is taking wicks out, what that means is price is going to push above them and it's going to do something called a liquidity grab. After this liquidity grab, then it's going to reverse. So the reason I'm putting this here, I know it might sound a bit irrelevant, but sometimes you have order blocks and the order blocks form equal highs and lows. But when there's equal highs and lows, I take extra precaution. Usually I won't even trade it. So again, I'm going to touch on this in my next video when I show you guys how to build trades with order blocks. But it's just something to bear in mind. And then different time frame order blocks and refining. So what this means is you have a 4-hour order block, right? As I showed you guys, you can find them on different time frames. I showed you one on 15-minute, one on the 4-hour. Within that 4-hour order block, you're going to have a 2-hour order block and a 1-hour order block and a 15-minute order block and so forth. Essentially, you can find order blocks. As I mentioned, this was one of my first points. You can find them on all time frames. So deciding which order block to use, which one to enter your trades with, depends on you and your system. If you're doing futures and you're using 15-minute chart, then of course you need to look at your, perhaps 30-minute, 1 hour, 15-minute order blocks, or even lower ones potentially to enter. But if you're doing spot trading, you want to be looking at your daily, your 4 hour, trying to catch those decent percentage swings, because you can expect price to react at them. And what I mean by that, I'm not saying that futures people can't use 4 hour daily order book. Of course you can, because you need to put them on your chart so you know they're there. If price is heading to that level, you need to expect reaction. So imagine you've got a bullish order block on your 4 hour chart, and now on your 15-minute chart, from what you've drawn up, you've shorted into that bullish order block. Most likely, if you're not managing risk, you're going to get liquidated, or you're going to get heavy drawdown. So you have to mark up your charts accordingly. You have to look at your order blocks accordingly. And again, massive point, spot trading, you can be using all these order blocks, all these concepts I'm teaching, FBGs, imbalances, that was my last video, and blending it all together, you can be trading without using leverage. So that's it from me for now. Here's all my socials. You guys can hit me up if you've got any questions at all. I'm going to be back very, very soon with the next video, and we're going to go into a bit more detail. Today, I'd just like to cover the concepts and essentially, how it works. And then next time, we're going to go a bit more into details with how to put it onto our charts and, make money from it. So I'll see you guys soon.